All roads lead to inflation. We're going to end up, but does all roads lead to inflation, therefore gold is a good investment? Is Bitcoin a good investment to you? I'm long gold. I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that. And I would own zero fixed income. If I had my cash, it'd be very short term.
Coming up today, the latest earnings results. Is the market melting up? Citigroup's new theory about the economy. IMF says the fight against inflation almost won. The latest from the BRICS, and how billionaire investors are positioning for a Trump win. And welcome back, everybody, to Click Capital, the most optimistic finance channel in the universe, where perma-bulls gather to exchange intellectual thoughts and perspectives on financial markets. However, you could also think of Click Capital as a support group for recovering perma-bears seeking help. And you could think of us like a cathedral for born-again perma-bull. In any case, all optimists are welcome here. Now let's dive right in. I've got a good one for you today. I'll let you know what billionaire Paul Tudor Jones has said about markets and how he's positioned his portfolio. And I'll also share with you an exciting group of stocks rallying hard today on the back of a government ruling. I think they could be coming into play. And also a certain group of commodity stocks catching a bid today and moving up. But for the here and now, markets are still trading pretty flat. Low volatility, continuing to hold up, grind higher. I still think it's possible we get that sneaky 2-3% down day, which should shake out a lot of weak hands. People getting scared of the election, October seasonality, all that stuff. And even though we may get a little follow through the next day or two, I think it'll be a buy the dip opportunity because we've still got the VIX coming down, now at 18.2. Have a looking at volatility risk premium, what option dealers are asking over realized, still quite hefty there at 9.4 points. So you see this quite often in market, wherever there's a great opportunity, like the 5th of August, shook out a lot of weak hands, people calling it crazy. If the market goes back to new highs, how can all this stuff happen? However, a lot of us bought the dip on that morning, especially in stocks like Palantir and other hot stocks like that, and the market's been pretty much nothing but up and to the right ever since. However, there's just too good an opportunity for the market to have a shakeout day or two, like these candles back here in early September. We get down 2%, I'd say that could cascade into a 3% down day, as a lot of people will start freaking out and get scared by the election. However, more on the S&P 500 later, along with all the hot stocks moving out there. First, just hitting the news wires as I speak. McDonald's getting slammed after hours, down over 8%. As we're just getting news, the CDC says an E. coli breakout linked to quarter pounders led to 10 hospitalizations and 1 death. Remember, this happened a few years back with Chipotle. Caused the stock to sink for a long time. However, we're not getting a whole lot of details on this breaking news. Just a big blue chip stock like McDonald's making a pretty huge move. Volatility adjusted. These big elephant stocks don't normally move this much. However, when you zoom out to the daily chart, really no big deal. We're just trading at 290, just a bit below the 50-day volume weighted average. And so no doubt MCD is going to gap down tomorrow. But what's also really moving out there a lot today, and has been for a few weeks, is the Trump trade. Global financial markets starting to price in that we should get a Republican win. And we can see that in election betting markets, with the blue party's odds absolutely nosediving. Just a few hours ago, we're sitting at 34%, getting a massive divergence now. And it's not just prediction market that are rallying, it's also financial markets. Stocks that can benefit from a manufacturing boom in the US, reshoring of production, stimulus potential tax incentives for domestic production, seeing lots of industrial, construction and engineering stocks continue to break out. Another one today, Mueller Industries on good earnings, and another trade kind of a little bit under the radar. Prison stocks, new political party, could be tough on crime, clean up the city's streets, restore law and order, and that's why we're seeing stocks like Geo Group. It's actually a REIT, they own prison facilities. And so that's right, as an investor, you can be a part owner of a prison. Another prison developer and manufacturer, CoreCivic, popped up a little bit this last week or so, hasn't got a whole lot of attention or people talking about it. However, this could be another group of stocks that may continue to find a bid here and move closer to the election. But there's spillover effects everywhere. Stocks like this, Funware, related to Trump, ripping up 38% today. They create mobile apps, and they created the last app for his 2020 campaign. So they're getting more into AI, and looks like this stock too is getting linked to his win. Getting a lot of attention there today. And the man's own stock, DJT, continuing its monster rip in line with those election odds over the last month. Going from a low of 1175, tripling in a month, up almost 10% today on volume. So what you're going to be hearing a lot about in the news over the coming weeks and months is tariffs, pretty much slapping a gain on the import of goods into the States that's actually paid at the port. it. Designed to influence the behavior of your trading partners. Generally speaking, economists hate it as it's set to slow down global trade, so no doubt we're going to be hearing a lot of blowback, pushback on that. However, I think they'll be used mostly as bargaining chips to extract something out of China. It just reminds me of the same rhetoric we heard back in 2016. It's going to cause a global recession, global wars, consumers going to fall off a cliff. Didn't quite all pan out like that. Actually had some of the lowest inflation, great GDP growth, consumer confidence back to multi-decade highs. However, it seems we're hearing the same rhetoric again, with Janet Yellen taking a swipe at him. She really doesn't want this guy in power. So the tariffs are deeply misguided, and this will affect America's advancement of their economic and security interests. Pretty interesting to hear that coming from Janet Yellen. Other research saying a win could actually fuel long-term buying opportunity in the Chinese market, which I agree with the sentiment as well, that he's more likely to try and negotiate a deal and use tariffs and the threat of tariffs as a bargaining chip, a negotiation tactic. As looking at his first term, his goal is really to negotiate peaceful relationships with the world's superpowers and others like North Korea, maybe not so much Iran, but I think we could see a cooling of tensions with China and Russia, not the opposite, just like what was predicted in 2016 as well, which we've actually seen over the last couple of years. But politics aside, more and more Wall Street pros are positioning for him to win, getting their portfolios into domestic companies, manufacturers, other businesses that could benefit from a boost in infrastructure spending, the repairing of America's aging and broken roads, bridges, other key infrastructure assets. We've got a bunch of investors now betting on the long end of the curve going up. That's long-dated bond yields, which means they think bond prices are going to go down. And that's what we heard from Paul Tudor Jones today as well. A billionaire hedge fund manager who I think is one of the best of all time. And similar to myself, he said he owns zero fixed income. He's actually looking to short the long end of the curve. He's long gold, he's long Bitcoin, and says pretty much the only path forward is inflation, no matter who's going to get in. US government finances are in such a bad position. It's a really tough spot. To get it back down, it's likely to take decades, if possible at all. And so what you've got now is two of the smartest guys in the business, Paul Tudor Jones, Stanley Druckenmiller, both betting on higher inflation, not wanting to own bonds. And I wonder what Jay Powell thinks about all this. Ever since he did his big dovish rate cut, 50 basis points, bond yields have done nothing but rally, especially on the long end, causing bond funds to continue selling off. At the same time, the market's expectations of inflation continuing to rise, whilst we've got the overall commodity complex seeming to catch a bid here, potentially starting a new uptrend. But what could really upset things is if we get another messy election. Swing states aren't able to decide a winner by midnight, along with all the other funny business we got last time. That's going to see a quick, sharp repricing in financial markets. Bitcoin and S&P futures are going to take a quick bath as markets will have got it wrong. However, most of the time they get it right, so this would be a surprise. However, I think if we do get a clean election, it'll be a landslide victory and the market could actually hold on to its gain and it won't be a big sell the news event that a lot of people are predicting. If not, some people say America's exceptionalism could be under threat. I don't really think so. I think it's definitely worrying if we get huge increases on tax, global wars persisting, probably not good for the US dollar and even more so inflation. However, the US is still the most dynamic, innovative economy and markets in the world. And so people naturally think because they've gotten so big, 65, it should just go down for no other reason other than it's a big number. Or if you look back in history, 100 years ago, it went there, so it should go back down. You got to understand the market doesn't trade off what happened 100 years ago. It trades off key fundamental drivers. And there's plenty of reasons for the United States to hold on to their domination of global capital markets and in fact even accelerate. I wouldn't be surprised if this hits 80% in the next 5-10 years. America just simply leads on all the most important industries and technologies of not only today, but tomorrow. And those could be potentially getting unlocked in an even bigger way in the coming years. And like Warren Buffett's always said, never short America. Just moving over to earnings. We just got a slew of companies coming today. Beats all over the place. We just got one miss, Sherwin-Williams. But all the other top ones, TXN, Verizon, Defense Contractors, Moody's, 3M, and GM, also having a really good beat there. In fact, having its best day since 2020. They topped Wall Street's expectations, actually raised their guidance. Now expect full year adjusted earnings before interest and tax between 14-15 billion or 10 to 10.50 a share, making the stock still very appealing on a valuation basis. To make over $10 a share, still only trading $50 a share. A lot of you guys remember I highlighted this stock late last year and early this year as being significantly undervalued. In fact, my stock fair value indicator still got it at $120 a share, now in a clean technical uptrend. But just looking at Ford, even though my indicator's showing it as undervalued, doesn't have that clean uptrend, still on this messy sideways kind of downtrend. And look at that beat for a company the size of General Motors. That is impressive. That's a lot of earnings momentum and revenue momentum as well. Really positive, strong factors for stock performance. And so I continue to believe, as I have done for a year, the gap between Tesla and General Motors valuation will continue to close. We've seen Tesla trade sideways and consolidate for a couple of years now, while General Motors looks to have well and truly put in a solid bottom here. But make sure you come back to Click Capital tomorrow night. I'll break down Tesla's earnings for you, whether they can impress the market, which hasn't been too impressed of late with what they've been doing. Gap down after the robo-taxi, Optimus Bot presentation, kind of just traded sideways, coiling up here. Still got a lot of exciting things in the future. Cybertruck, full self-driving, in addition to robo-taxi and Optimus Bot. Battery storage business, which has been exploding, have been suffering from high interest rates, flood of cheap EVs from China. I think they've actually stood up quite well in the face of all that. Kind of mixed predictions coming from Wall Street analysts, what they think we'll get tomorrow. We're really looking for details on their Model 2, real low-cost EV to compete with all those cheap Chinese EVs. They may just do a slide deck on their Q3 earnings presentation tomorrow, and I think that could get the stock popping higher. We get some good details on the Model 2. That should be well received by Wall Street. And of course, as per usual with every earnings, we'll be looking for a beat on what analysts are expecting them to have posted in profit for the quarter, almost 60 cents a share, along with their forward guidance. The last couple of earnings, they actually missed expectations, why the stock's pretty much been trading sideways for a few years now. My gut feeling is they're going to beat expectations, hopefully give us some good guidance, along with details on the Model 2. I think we could potentially gap up 10% or more above 240 towards 250. However, I could be wrong. No one can see the future with 100% certainty, and I've already got buy limit orders in place to add to my long-term position under $200 per share and $190 as well. If we do get a spike down after hours or into Thursday's session, I will be buying the dip. And according to Morgan Stanley, earnings so far prove that investors should stick with stocks in this corner of the market. They're saying financials have outperformed this earnings season, and that proves cyclical stocks are poised for gains. And they're set to be rewarded for beating lowered earnings expectation. And that's kind of the price action we've been seeing in the retail sector pretty much all year as well. Consolidating, bumping up and down. This is obviously leveraged to the consumer. However, when looking at a weekly chart, and I know this is another contrarian view, I think we're poised to break out. Keep pushing up here with some high lows. I think it would surprise a lot of people to see these consumer cyclical stocks break out, as we could be on the cusp of a really busy holiday spending period. In fact, the S&P 500 could have the potential to go into a melt-up mode. Like I said, we've already got the most supportive and loose government and Fed of the market. Now the market's pricing in a pro-business administration, loosening regulations. That's all music to the market's ears. Along with this momentum, sector-wide participation, there is the potential for it to accelerate on the upside. Like I said, I'm pretty sure we've got a little shakeout just around the corner, but we could still be moving into that really bullish seasonal period, Santa Claus rally. However, if that were to happen, according to Jefferies, they're saying to hunt for stocks that are still trading at value prices, which when looking at large cap US growth stocks, pretty hard to find. Market just doesn't leave amazing opportunities lying around for too long. And another big driver of this secular bull market is record corporate buybacks. Companies using their cash to buy back shares, decreasing the supply of stock, and that squeezes stocks a lot higher. In fact, looking back in history, head and shoulders above the dividend aristocrats, companies that consistently increase their dividend every year for over 25 years, the S&P itself, and high dividend stocks. However, you could think of the S&P 500 and NASDAQ almost like a buyback index. The top stocks constantly buying back billions over their own shares, along with billions being poured into the market every day from all our retirement funds. Anyone in the world that can buy US stocks, American stocks, are likely to trade at premium valuations for decades to come, in my opinion. And we just continually get more and more good signs of market breadth. Just looking at this heat chart here of the S&P 500 equal weighted index. That gives an equal weight to all 500 members of the index. Down the bottom here, the percentage of members with new 52-week highs. So currently sitting just below 15%, but what you want to pay attention to is the trend. And so when you see markets uptrending or breaking out, you want to see that confirmed by breadth. Breadth often leads price, and you'll get divergences. You'll see breadth pull away, the market kind of stumble, consolidate, or even continue to rise, and generally breadth is right. And you can look for bottoms and divergences in breadth as well. But right now, breadth is looking really healthy across all areas of the market. Unbelievably, some people are still holding on to that old theory as the Mag 7 driving this bull market, which you could make an argument for last year. However, right now, just simply not the case. In fact, just looking at my sector breadth table indicator, we've only got one sector that has more than half of all stocks below its 200-day long-term moving average. That's energy, which funny enough is getting a bump up right out the front. The energy sector has the lowest correlation with the market, and that's why it makes for a great diversifier in a portfolio. Just looking at the 20-day moving average, we've got financials and utilities holding up the best here. Not too far behind, REITs and industrial. And looking above the 50-day, it's actually financials, industrials, and utilities. Still holding up the best when looking at sector breadth. We've also got other technical signs the market is climbing a wall of worry. The S&P 500 up the top here. Down the bottom, you've got the spread 3-month VIX relative to the VIX. And those of you that have TradingView, you can look at the VIX 3-month index by just typing in VIX 3M. And so typically, when looking at volatility term structure, further out you go, normally the higher priced it is. Also known as tango, because the market will make you pay a premium for buying volatility insurance the further out. Because for example, say 6 months from now, it's more likely we get a spike above VIX 25 at that point as opposed to the next month, and that's why the market has a bit of premium in its term structure. But anyway, back to this chart of the 3-month VIX relative to the VIX, currently at 105, which is the same as what I'm seeing when I draw up this spread chart inside my trading view as well, 105. And so that's oversold, that's overbought. And you could think of it when it's getting low, market's pricing in less uncertainty and less volatility and fear 3 months out compared to now. The normal VIX index just looks at 30-day options. So that's hit the oversold level, bounced a little bit back above 1, which is a positive reading. You can see there on the 5th of August, got super oversold, and that was actually a great buy signal. And this pretty much goes in line with the consensus I'm seeing online as well. People think the market's on the verge of a crash any day. It's the election, it's October, it's crazy. We had this similar pattern happen 74 years ago, therefore it must happen today. All the fundamentals don't matter. However, I think this market is climbing a wall of worry. And the fact is we've got the NYSE advanced decline line. Basically the amount of stocks moving up versus down, hitting a brand new all-time high. Market breadth's pretty much as good as it gets. And the AI boom continues to power on. Look at this chart of how Nvidia makes money. Simply incredible. So over 20 years ago, they were mostly for gamers. And big companies discovered their GPUs are actually good for their AI models. Now their data center business absolutely dominates, growing 154% year over year, while all their other categories continue to grow healthy as well. What's truly amazing though is on 30 billion of revenue, the cost of that revenue is only 7.5 billion, giving them gross margin of 75%, operating margin of 62%, and a net margin of 55%, which is absolutely insane for a company of this size. Print more cash than a bank. So like I said yesterday, I think we're still in the early stages of a fourth industrial revolution, and the world needs to be powered by Nvidia's advanced AI chips. And so I think they're likely to dominate many more years ahead. And all the big risks bears were harping on about the last couple of years just haven't simply played out. Commercial real estate, one of the biggest. Big secular trend after COVID, work from home, depleted office buildings all over the world, in fact, not just America, caused a big dive in commercial property prices. However, that didn't really affect financial markets much at all. We had a little scare in March last year with regional banks, a few digital bank runs. Fed got underneath it pretty quick, and they already got out in front of it with commercial real estate as well. Modern day financial markets can digest this pretty good. And there's a look at the real estate ETF from iShares, which, like I pointed out to you guys back in July, broke out of this big downtrend, potentially doing a stage 1 base, now in a stage 2 advance. REITs have been a good trade the last couple of months. And so we're getting a bit of a bump up in the dollar and bond yields, I'd say on 2 counts. Increasing expectations of inflation to come back thanks to an ultra loose Fed, government spending off the charts, but also potential red wave that could actually lead to a strengthening of the US economy and potentially GDP to continue accelerating, which if so, is both a positive for the US dollar and US bond yields, helping to keep a significant differential between the rest of the developed world, and that's helping to keep the dollar propped up. Long term still got issues with debt. However, as long as there's a big interest rate differential between the US bond yields and the rest of the world, they will continue to hold the dollar up. Interesting to see some polls still got the blue team out in front. However, I'm going to place my forecasts in line with what the money's telling us, not what these polls are, which are notorious for getting it very wrong. And so now the bond market's flipped, selling off. Caught a lot of traders and investors offside. People thought the Fed's cutting. That's great for bonds. They got into bonds. However, like I said back then, as hard as it was to believe, we may have seen the low in yields because the market already front run that big cut. Now it's worried about inflation, along with the potential for the US economy to actually hold up. I'd say for yields to really take out 350 again on the 10-year, we'd actually need a recession. Otherwise, we may not see 350 again for who knows, a long time. And I have zero interest whatsoever in owning bonds. Haven't for years. Just think about what they are. It's loaning your hard-earned money to the government for 10 years. Does that really sound like a good proposition to you? Because when you're long bonds, just like when you're long cash, you're short inflation, and that is a very tough trade given the current global macro environment we're in now. You can look at any stat from 50 years ago, and I'm telling you, it's different now because of the debt, the Fed's balance sheet, and now China looking to get in on the same game. Just be a flood of currency and liquidity out there. That's inflationary for assets. And more good news for us commodity bulls. Fed doesn't want to slow down either. Just heard from Fed President Mary Daly today. No reason to pause rate cuts. Keep the good times rolling. Get those interest rates down to 2%. How they think that's not going to bring back inflation is pretty much a joke. Because like this guy said on X today, if the Fed doesn't want a recession, then they'll get inflation again. It's one or the other. You can't have it both ways. Agreed 100%. In fact, Citigroup's got a new theory about the economy, and they're unveiling a no-cycle theory, which I think is pretty interesting. It does have some substance to it, making an argument that we keep getting these indicators saying we're on the cusp of a recession like we have for the last couple of years, and some historical cycles just don't look to be playing out, and that's potentially because The economic system is still normalizing after the pandemic. I think people underestimate how big a change what the government and the Fed did back then. Absolutely flooded the system with liquidity, blown out a lot of stats, and I think may have actually affected some of the normal cycles. And people will say to me, oh, you're saying it's different this time. Yes, 100%. That's what I'm saying. What's happening now is different from what happened 20, 40, 50 years ago. We didn't have COVID back then. We never had a global pandemic in our lifetimes. S&P 500 was already ripping going into COVID. Fed's balance sheet was below 4 trillion. They blew it up to 9 trillion, along with government spending going off the chart. I just don't think all that's going to wash out of the system just in a few short years. Could actually have ripple effects that last 10, 20 years. Some things may be changed forever. And believe it or not, markets do get more efficient over the longer term, along with the structural secular trend of higher valuations and lower interest rate over the last 200 years as well. And that's why we're getting things like this happen, which is different this time. When you're looking at the 10-year US yield around Fed cuts, typically the market sees it coming, and it kind of consolidates and drifts like a little bit lower. You can see here in the range of possible outcomes in history, kind of just goes sideways for quite a few months afterwards as the market sees it coming. However, what we're doing here in the blue line is completely different to anything we've done in history after the Fed has cut. Straight away, yields have shot up. So according to the bond market, which is pretty much the biggest, smartest market in the world, according to them, it is different this time. That's why you got to pay attention to key fundamental drivers. Instead of just digging up stats from 50, 70 years ago, might actually have little relevance in today's modern markets and all the events that we've seen happen. We've seen a sharp repricing in Fed fund futures as well. How many basis points they think the Fed's going to cut over the next year? They now only see about 150 basis points in cuts and climbing. And we just got the latest World Economic Outlook growth projections from the International Monetary Fund. They think the global economy is going to grow at 3.2% this year, same next year. Advanced economies, 1.8, emerging market and developing, 4.2. So they're not forecasting a recession. And again, what's bringing down this 1.8 is the European countries stuck in what seems like they're forever low growth mode. Big difference between America. Another good sign for commodity bulls like myself, they also said the global fight against inflation is almost won. Classic headline to fade. I think it should be saying they wish it's won, because I'd be very surprised if we don't get a resurgence in inflation in the next year or two. No matter who gets in the White House, just from what's happened in the last 4 or 5 years, can't just go away overnight. And I think that's more likely than a recession. Best case scenario, no inflation, no recession, be an amazing achievement markets can get. Back to awesome growth with low inflation. Who knows, maybe AI can actually help that. But at the end of the day, like Jack on X says, I'm not listening to what Janet Yellen's saying or the IMF or some other economist. I trust the billionaire hedge fund managers, the guys who actually trade and invest for a living. I've been watching markets for 50 years. And I'm positioned in a very similar way to these guys, along with David Tepper as well. So moving on to commodities, we got oil bouncing back today, catching a bid here off support, bumping around. There's crude reclaiming. It's 50-day today, above 71 a barrel. As apparently, once again, Israel's still on the cusp of striking back to Iran. Seem to be hearing the same thing every day for about 3 weeks now. So we could still get that headline any day now. Have to wait to see what the Iranians do in response. And I'd say that's likely helping gold stay well bid here. Seems momentum's overtaken. Still got bullish seasonality. My trend strength indicator still at only 3, which typically trends don't peak out until we see it go above 20 or 30, like back here in April. So this could still potentially run. A lot of momentum, especially we get some fireworks happening in the Middle East. However, we are starting to get quite a bit giddy amongst traders and Wall Street. Everyone and their dog jumping on board gold now. Bit of a pile-on. Even hearing news that 77% of Costco outlets that stock bullion bars was sold out in the first week of October. Mainstream is rushing into gold, so we could have a bit of a short-term pullback or consolidation just around the corner. However, the long-term bull thesis still remains intact, why I plan on holding on to my junior gold miners for many more years. Just looking at this chart here. At the last highs in gold back in 2011, 1980, the gold price in USD. What's interesting is looking at the monetary base in the US, M3 supply, federal debt, median house price, S&P 500. Some of them have actually accelerated a lot more than gold. Looking at the ratios of, for example, US federal debt has more than doubled since 2011. However, gold still has not. Same with median house price. Stocks up more than quadruple as measured by the S&P 500 index. Gold is not. Same with the amount of currency. It's gone up a lot more than gold. This current bull run in gold, I think it's not only going to pass 3,000, we're likely to hit 5,000 and who knows, maybe 10,000 by the end of the decade. Commodity markets have really long bull and bear cycle. But what's been really hot of late this week is silver. Breaking out. 10-year highs. Solid candles here. Ripping up as we had been getting rumors. Central banks, the BRICS, maybe starting to add silver to their global reserves. Maybe that's what all this volume is. That too, bullish seasonality, really good technicals here. Still got a lot more room to run. Looking at trend strength. And the fact is, silver is one of the metals of the future, getting used more and more in a lot of applications, industrial uses, AI, electric vehicles, batteries, you name it. World's going to need a lot of silver. And the BRICS are just hosting their summit. Russia pushing for a new world order, looking to pull in welcome more and more countries into the BRICS alliance, in which they could be challenging the Western alliance, quickly approaching the same size as Western GDP. The next shoe to drop will be military leverage, which if they achieve is not likely a good thing for the West. Hopefully we don't keep going into this bipolar world and we can get back to working together instead of fighting each other. However, this current admin is intent on anything but that. Just heard again today, Treasury Secretary Janet Yellen said the US will unveil strong new sanctions aimed at curbing Russia's Ukraine war effort, and that they're going to unlock the value of frozen Russian sovereign assets, pretty much hand them to Ukraine. And this is a big reason why the BRICS are moving away from the US dollar. We've seen what the US did to Russia, freezing all their assets, basically scared the crap out of everyone else, why they want to get into gold and other things and away from the US dollar. They don't like the US having that leverage over them. At the same time, whilst announcing another $50 billion loan to Ukraine, she called out China's lending practices and called for more debt relief, giving further instructions to the Chinese, which they find amusing and push back on, as their criticism has been current American government leaders shouldn't be telling the Chinese what to do, as they criticize them for financing global wars, having spent trillions and trillions of American taxpayer money, numerous wars all around the world, when China hasn't invaded a country in over 40 years, nor have they financed any major wars. Instead, they've spent that money on national development, and anyone who goes there will tell you how modern their cities, roads, and infrastructure really is. We also heard from Yellen today that fiscal deficit reduction is required over the coming years, to which one guy said on X today, translation, once I'm retired, it's up to who's left to clean up this mess. Agreed 100%. Now moving on to an interesting story today that I alluded to at the start of this video. Bunch of exciting stocks moving up today. We just got the Federal Aviation Administration issuing a final rule for the qualifications and training that instructors and pilots must have to fly aircraft in the powered lift category. So it looks like they're moving more and more towards giving this industry the green light. Whole new category of aircraft that we haven't seen in decades and decades. 5-10 years from now, maybe hopping in one of these things to get into the city. Obviously, it's still early days, still a long way to go. There will be a lot of safety concerns. Will require a lot more investment from us investors to put the capital behind this new technology. However, that looks like what we're getting today. Joby Aviation trading up over 12% on heavy volume. Market cap $4.4 billion coming out of Southern California. And here's a look at the Joby Aviation website. Electric aerial ride sharing powered by 6 electric motors. Our aircraft takes off and lands vertically, giving us the flexibility to serve almost any community. Flying with us might feel more like getting into an SUV and boarding a plane. 0 operating emissions, 1 pilot, 4 riders, quiet as a conversation, 200 miles per hour top speed, been in development 10 years. Pretty interesting stuff, really. This could be one of the future modes of travel, in addition to robotaxi, as AI and robotics integrates further and further into our society. Definitely an exciting trend out there. Another one, Archer Aviation, up 7% today on volume, 1.1 billion market cap, also coming out of Southern California. They don't have any revenue yet. And another smaller one today, not really trading up a whole lot, but getting some volume coming in there. Vertical Aerospace, really small speculative stock, 128 million market cap, obviously no revenue, coming out of London, United Kingdom. Once again, another interesting, exciting technology that's picking up pace and momentum in the world today. But like I said, obviously still very early stages, still got plenty more years to go in this secular trend. The stocks are very speculative, but nonetheless, I've got these on my watch list as another secular trend I'm interested in. Also looking at the stock I did a quick profile on yesterday, TeraWulf, Bitcoin miner, Stanley Druckenmiller's invested in, breaking out to a fresh 52-week high today, 5%, as Bitcoin just pulling back a touch after getting a little technically overbought there. I'd be expecting the dips on this to get bought as well. Also, the other group of commodity stocks I said I'd let you guys know about today, lithium, catching a bid here, PLL trading up 15%, Standard Lithium up 12%, Lithium Americas up 10% on volume, and Sigma Lithium also catching a bid here today, along with a little bounce in the Global X Lithium and Battery Technology ETF. Just going out to a weekly chart here. Lithium, like a lot of clean energy, been beaten down a lot these last couple of years. Higher interest rates, a lot of clean energy stocks and sectors really not catching a bid as they're pricing in a Republican win. How the lithium is, again, another important commodity of the future, may have just put in a bottom here. And just going out even further to a monthly chart, I think we can draw a little bit of a downtrend line here. See if lithium can break out above this. Certainly a sector and some stocks I've got my eye on as one of my next investments. And that's pretty much a wrap for today's daily market review, guys. Thanks very much for tuning in with Click Capital. I hope you enjoyed it, and I'll see you all again tomorrow for Tesla's earnings. Cheers.